The most financially fragile people I know aren't the ones making 40,000 a year. They are the ones making 400,000. It sounds counterintuitive. You see the least luxury SUV, the right zip code, and the private school tuition, and you assume safety. But if you were to peel back the curtain on those lives, you wouldn't find wealth. You would find zero liquidity, mountain-high liabilities, and a silent panic. They are running on a financial treadmill set to maximum speed, and they cannot afford to turn it off for a single month. In the financial world, we have a specific acronym for this demographic: Henry, high earner, not rich yet. It describes a financial purgatory where your income places you in the top 10%, but your actual net worth places you in the bottom 50%. And if you are watching this, feeling a knot in your stomach because you make six figures but still worry about the grocery bill, you are already in the trap. Here is the uncomfortable truth that most high achievers ignore. Income and wealth are not the same thing. In fact, they are often enemies. Income is simply how much money flows through your hands. Wealth is what remains. The Henry trap works because high income convinces you that you are rich, giving you the social permission to spend like you are rich, which guarantees you never actually become rich. Think about the surgeon earning $500,000 who spends exactly $500,000 to maintain their image. Technically, they are broke. Now consider the mid-level manager investing 40% of their salary. One looks rich, the other is becoming wealthy. We are going to dismantle this trap today. I am not going to tell you to stop drinking lattes or to clip coupons. That is advice for people with an income problem. You don't have an income problem, you have a psychology problem. By the end of this video, you will understand why making more money has actually made you feel poorer and exactly how to break the cycle so you can stop looking wealthy and actually start being free. The hardest part of the Henry trap isn't the math. It is the silence. If you earn $50,000 a year and struggle to pay your bills, society offers you sympathy. But if you earn $300,000 a year and struggle, society offers you judgment. There is a profound shame attached to being a high earner who is living paycheck to paycheck. It feels like a moral failing. You look at your bank account, then you look at your paycheck, and the gap between the two makes you feel incompetent. You think, I am smart enough to earn this money, so why am I not smart enough to keep it? Because of this shame, you keep it a secret. You suffer in isolation, convinced that you are the only one drowning in the deep end. But here is the secret that nobody whispers at the country club or the executive retreat. You are not the outlier, you are the norm. I have looked at the balance sheets of hundreds of high earners, doctors, lawyers, senior engineers, founders, and I can tell you that the polished exterior usually hides a chaotic interior. When you look around at your peers, the ones with the renovated kitchens and the ski trips, you assume they have a secret wealth code that you missed. They don't. They are just financing the same illusion you are. Most of the wealth you see in high-income neighborhoods is actually just debt wearing a designer outfit. It is high cash flow masking low solvency. But here is where it gets interesting. The reason this happens is not because you are bad with numbers, it is because of a psychological mechanism called lifestyle calibration. When your income jumps, your baseline for what is normal doesn't stay put. It jumps with you. You don't just get a raise, you get a new peer group. Suddenly, the Honda Accord that was perfectly fine for the junior associate looks out of place in the partner's parking lot. The vacation you used to love now feels budget compared to where your colleagues are going. You aren't consciously trying to show off, you are subconsciously trying to belong. This is the insidious nature of the trap. You aren't burning money on things you don't want. You are spending money to maintain your standing in your new tribe. And this creates a terrifying dynamic. Your lifestyle becomes a liability that you have to service every single month. Think about the difference between a high earner and a wealthy person. A wealthy person owns assets that pay them. A Henry owns liabilities that they must pay. The house, the cars, the private schools, the club memberships, these aren't assets, they are invoices. You have effectively built a machine that requires 100% of your energy just to keep running at zero. You cannot afford to take a break. You cannot afford to change careers. You cannot afford to have a bad quarter. This is why high earners are often the most stressed people in the economy. A low earner worries about survival. A high earner worries about maintaining the altitude. The fall is much further, and the humiliation of the crash keeps them running on the treadmill long after they have burned out. To the bank, you are a premium customer. To the luxury brands, you are a VIP. But to your own future, you are non-existent. We need to stop treating this as a spending problem. If you could have budgeted your way out of this, you would have done it by now. This is not about cutting Netflix. This is about realizing that your income has become the architect of your own prison, and the only way to break out is to stop looking at what your money buys you and start looking at what your money is costing you in freedom. To understand how you got trapped, we have to look at the mechanism of your career. Most high-income careers are high-stress environments. You are trading a significant amount of your mental bandwidth and autonomy for that paycheck. This creates a psychological deficit. By the time you clock out, you are depleted. You feel like you have sacrificed a piece of yourself for the job. And this is where the trap snaps shut. Because your brain, seeking equilibrium, demands a reward for that sacrifice. You tell yourself, I work this hard, I deserve to enjoy it. This phrase, I deserve it, is the most expensive sentence in the English language. It is the emotional logic that justifies the $80,000 car and the 5-star resort. You aren't just buying things, you are buying dopamine to soothe the pain of the grind. You are self-medicating with luxury. But here is the catch. The more you spend to soothe the stress, the more you need the income to support the spending, which means you need the stressful job even more, which creates more stress, which requires more spending. It is a perfect self-reinforcing loop. You are effectively paying a tax on your own misery. Now, add to this a fundamental law of economics that governs human behavior. Parkinson's law. In personal finance, it means that expenses expand to match the income available. It happens so slowly, you don't even notice it. When you were a junior employee making $60,000, you managed to live, you were fine, then you got promoted to $120,000. Suddenly, the old apartment felt cramped. You upgraded. You didn't save the difference, you absorbed it, then you hit $250,000. Now, the sensible upgrade isn't enough. You need the house in the right school district. You need the membership at the club where business happens. You convince yourself that these are investments in your career. But if we look at the math, they are structural liabilities. This is the phase I call the great anchoring. The defining characteristic of the Henry trap is the accumulation of fixed costs. You don't just spend money, you sign contracts. You sign a 30-year mortgage that demands $8,000 a month. You sign leases on 2 vehicles. You sign tuition agreements. You convert your liquid cash, which is freedom, into fixed obligations, which are chains. If you make $20,000 a month, but your fixed floor of expenses is $18,000, you are mathematically identical to someone making $2,000 a month with $1,800 in expenses. Actually, you are worse off. Because the person with low expenses can easily pivot. They can downgrade their lifestyle in a weekend. You cannot. You cannot quickly sell a luxury home in a down market. You have built a massive, heavy infrastructure that requires a constant, high-pressure fuel injection of cash just to stay upright. This is why you feel poor despite the high income. You don't have money. You are a conduit for money. It flows in from your employer and immediately flows out to your creditors. You are simply the middleman in a transaction between your job and your lifestyle. So why do smart people let this happen? It isn't random. It happens because you have fallen into 5 specific psychological traps that are uniquely designed to capture high earners. We need to walk through these traps one by one. You need to identify which ones are currently operating in your life, because you cannot dismantle a prison if you don't know where the bars are. The first trap is the liquidity illusion. This is the most common error I see on balance sheets north of $200,000. The liquidity illusion is the belief that because you have high cash flow, you are wealthy. You look at your bank account on the 1st and the 15th, and you see significant numbers hitting the ledger. That feeling of cash moving through your accounts creates a false sense of security. It feels like abundance, but cash flow is not wealth. Cash flow is simply the speed at which money moves. When you suffer from the liquidity illusion, you stop asking, "Can I afford this asset?" and you start asking, can I afford the monthly payment? This is a critical shift in mindset that keeps you poor. When you buy a car based on the monthly payment, you are focusing on the flow, not the accumulation. You are effectively renting a lifestyle from the bank. The bank loves you for this. You are their ideal product. But the moment that cash flow stops due to a layoff or burnout, the illusion collapses instantly. You realize you don't own your life. You are just the highly paid manager of it. The second trap is the proficiency paradox. This one targets your ego. If you are a high earner, you are likely very good at what you do. You are an expert surgeon, a skilled litigator, a brilliant software architect. Because you are highly intelligent in one area, you subconsciously assume that competence transfers to money management. You think, I am smart enough to navigate complex mergers, surely I can manage my own portfolio. But earning money and keeping money are two completely different skill sets. To earn high income, you often need to be aggressive, specialized, and optimistic. To build wealth, you need to be conservative, diversified, and pessimistic. When high earners apply their earning mindset to their investing strategy, they get crushed. They make concentrated bets. They buy into complex private equity deals they don't understand because it feels exclusive. I have seen doctors lose decades of savings because they invested in a friend's restaurant, convinced their general intelligence would protect them. It didn't. Intelligence in one domain does not immunize you from stupidity in another. The third trap is the forever bias. This is the assumption that your current income is a permanent baseline. When you hit a high income bracket, your brain linearizes that trajectory into the future. You assume you will make this money, or more, for the next 20 years. You build a fixed cost lifestyle based on your peak earning years, assuming they are your average earning years. This is dangerous because high income careers are rarely linear. They are volatile. The tech sector contracts, the law firm restructures, or more commonly, you simply burn out. The energy required to sustain a $400,000 corporate role at age 35 is very different from the energy available at age 50. But if you have locked yourself into a lifestyle that requires that income just to keep the lights on, you have removed the option to downshift. You are betting your entire financial future on the premise that nothing will ever go wrong. That is not a financial plan. That is a gamble. The fourth trap is the convenience premium. This is the silent killer of wealth for busy professionals. Because your time is highly valuable, you justify overpaying for everything in the name of saving time. You order dinner delivery every night. You lease the car with the all-inclusive maintenance package. You book the expensive flight. You tell yourself, my time is worth too much to worry about saving $50. And in isolation, that is true. It doesn't make sense for a CEO to clip coupons. But when you apply this logic to every single aspect of your life, you end up paying a 30 to 50% premium on your entire existence. You aren't just trading money for time, you are bleeding out the very margin that could buy your freedom. You are using your high income to subsidize a lack of intentionality. You are effectively paying a lazy tax on every transaction. And because the shovel is so big, you don't notice the hole you are digging until it is too deep. The fifth and final trap is the status asset fallacy. This is the most insidious because it is driven by our biology. We are social animals. We crave status. In the Henry world, we confuse status assets with wealth assets. A wealth asset puts money in your pocket. A stock, a bond, a rental property. It is often invisible. Nobody sees your brokerage account. A status asset takes money out of your pocket but signals to others that you have money. The luxury SUV, the remodeled kitchen, the designer watch. The trap is that high earners often fill their asset column with status assets and fool themselves into thinking they are building wealth. You look at your $1.5 million house and think, I am rich. But if that house costs you $8,000 a month to carry and generates zero cash flow, it is not a wealth engine. It is a consumption engine. You are buying acceptance. You are buying the feeling of belonging to the tribe of successful people. But most Henrys are buying these status assets instead of wealth assets, not in addition to them. They are optimizing for how wealthy they look rather than how wealthy they are. And here is the brutal irony. The people you are trying to impress, They are too busy worrying about their own status to care about yours. You are going broke to impress people who aren't watching, using money you don't actually own. These 5 traps explain why a lawyer can generate $10 million in lifetime earnings and retire with less than a school teacher who simply bought index funds and lived below their means. The lawyer was playing a high-stakes game of cash flow management. The teacher was playing the game of wealth accumulation. If you see yourself in these traps, don't panic. The first step to escaping the prison is realizing that you are in one. The system is working exactly as it was intended. It extracts your labor, pays you a premium, and then immediately recaptures that premium through lifestyle norms and social pressure. But now that you see the mechanism, you can choose to jam the gears. The question is not, how do I make more money? You have already solved that. The question is, how do I stop the bleeding? And the answer requires a fundamental shift in how you view the purpose of your income. So, how do we cure it? Most financial gurus will tell you the answer is a budget. They will hand you a spreadsheet and tell you to track every latte. But I am going to tell you something different. If you are a high earner, budgeting is not your solution. In fact, for you, budgeting is often a trap in itself. You are already making thousands of micro decisions every day at work. Asking you to come home and agonize over a $4 coffee is a recipe for failure. You will do it for 3 weeks, you will feel miserable, and then you will revenge spend to make yourself feel better. The escape plan isn't about restriction, it is about automation. We need to build a system that saves you from yourself so you don't have to rely on willpower. We are going to reverse engineer the very traps we just discussed. The first step is what I call severing the nerve. Right now, there is a direct nerve connection between your income and your spending. When one goes up, the other twitches and moves up with it. We need to sever that connection. You do this by defining your enough number. This is a specific annual dollar amount that you decide is sufficient to live a comfortable, happy life. Maybe that number is $150,000, maybe it's $200,000. Whatever that number is, that is your cap. Anything you earn above that number does not exist for consumption. It is not money for you to spend. It is capital for you to deploy. When you mentally decide, I live on $150,000 a year, regardless of whether you make $200,000 or $500,000, you regain control. You stop looking at the surplus as extra money for a better car and start seeing it as freedom credits. The second step is to operationalize this with artificial scarcity. Remember Parkinson's law? Expenses expand to match income. We are going to use that law to our advantage. We are going to artificially lower your income. If you earn $20,000 a month but you want to save $8,000, you don't wait until the end of the month to save what's left, because nothing will be left. Instead, you set up an automated transfer that moves that $8,000 out of your operating account the second it hits. It goes to a brokerage account, a separate bank, anywhere that is hard to touch. You are effectively imposing a shadow tax on yourself. You learn to run your life on the remaining $12,000. And the amazing thing about human adaptability is that you will adjust. You won't starve, you won't suffer, you will simply stop buying the things that didn't matter anyway. You are creating a scenario where you are broke in your checking account but getting rich in your brokerage account. The third step is the 50% rule for future growth. One of the hardest parts of the Henry trap is the feeling of deprivation when you get a raise. You work hard for that promotion, and it feels unfair to save 100% of it. So, don't. Adopt the 50% rule. Every time your income increases, a bonus, a raise, a new client, you take 50% of that new money and add it to your lifestyle. Enjoy it. Upgrade the car, take the trip, but the other 50% goes directly to your freedom fund. This does 2 things. First, it satisfies the I deserve it psychology. You get a reward. But second, it mathematically guarantees that your savings rate increases with your income. You are allowing lifestyle creep, but you are controlling the speed. You are ensuring that your wealth grows faster than your ego. Finally, and most importantly, we need to execute the asset flip. This is the psychological shift where you stop buying status and start buying time. The next time you're about to sign a contract for a liability, I want you to calculate the cost not in dollars, but in runway. If your monthly burn rate is $10,000, and you are looking at a car that costs $1,200 a month, that car isn't just costing you cash. Over a year, that car costs you nearly 1.5 months of freedom. Is the leather seat worth working an extra 6 weeks every single year? Maybe it is. But for most people, when they frame the purchase as trading my life rather than spending my money, the desire evaporates. You start to realize that the ultimate luxury good isn't a Rolex. It's the ability to wake up on a Tuesday morning and realize you don't have to go to work if you don't want to. That is the transition from high earner to wealthy. A high earner uses money to build a golden cage. A wealthy person uses money to build a key. When you start valuing the key more than the cage, the trap dissolves. You stop caring about what the neighbors think of your driveway, and you start caring about what your bank account thinks of your calendar. This isn't about living like a monk. It is about realizing that you have been playing a game you cannot win. The game of status has no finish line. There is always a bigger boat. There is always a faster plane. But the game of freedom, that has a finish line. And if you are making a high income, you are closer to it than you think if you just stop running in the wrong direction. We started this conversation by identifying the silent panic of the high earner. The person who makes $400,000 a year but still worries about the grocery bill because the math doesn't add up. Now you know that the math was never the problem. The problem was the invisible script you were following, the one that told you a high income mandates a high cost lifestyle. Breaking the Henry trap requires a deliberate rebellion against that script. It demands that you stop measuring your success by the texture of your upholstery and start measuring it by your unencumbered cash flow. Real wealth is boring. It is quiet. It is the money you didn't spend. It is the option to take a sabbatical, to start a business, or to simply say no to a meeting you don't want to attend. That is a luxury that a leased luxury SUV can never give you. The next time you get a raise, don't look at it as permission to upgrade your cage. Look at it as a purchase order for your freedom. Every dollar you don't burn on status is a dollar that buys you time. You have the shovel. You have the income that 99% of the world dreams of. You just need to stop digging the hole deeper and start building the ladder out. If this approach to wealth psychology resonates with you, if you want clarity, not hype, and strategy, not sound bites, then subscribe to the channel. We are going to keep dismantling these traps one by one. I'll see you in the next video.